Episode 3: The Global Unwind. On a Tuesday in mid-2024, the floor gave way. Pluralsight, a $3.5 billion pillar of the software-as-a-service boom, didn't just decline, its equity was incinerated in a clinical handover of keys to its creditors. While the public was told these assets were stable, the internal ledger was a crime scene of valuation fractures, with different lenders marking the exact same corpse at 97 cents and 48 cents simultaneously. We think the $620 billion maturity wall approaching in 2026 is a market accident. But if you look at the data from the 2008 regulatory migration, you realize this was a rehearsal. This is a forensic investigation into the terminal phase of the global credit cycle. I am speaking to you from inside the confidential chamber, releasing this dossier before the final systemic closure. By the end of this hour, you will possess the sovereign exit protocol. You will understand the mechanics of the Bermuda Magic Box, where your retirement checks are laundered into paper profit through offshore regulatory arbitrage. We will reveal why the banking sector has not de-risked, but has instead metastasized into a tiered infrastructure for a $2 trillion shadow ledger that is currently fracturing under its own pressure. This hour serves as your mentor and protector. But before we deconstruct the weapon, we must see the wire connecting your own capital to the fuse. The primary objective is to expose the mechanism of the trap before its final activation. This is not a drill. It is the forensic accounting of a systemic Chapter 11: The Bank-NBFI Nexus. To understand the crime, we must first inspect the weapon. Chapter 11 exposes the Bank-NBFI Nexus. We dismantle the fiction of bank de-risking and reveal the tiered financing structures that have made the global banking architecture the prime broker to the shadow economy. Section 1: The Illusion of De-risking. The post-2008 regulatory architecture was predicated on a singular objective: to de-risk the core banking system by migrating credit volatility into the shadow ledger. Regulators promised that by dispersing risk among sophisticated institutional investors, pension funds, and sovereign wealth funds, the system would achieve a state of permanent resilience. Forensic analysis of the 2024 and 25 period proves this dispersion was a clinical illusion. While banks have reduced their direct hold-to-maturity exposure to leveraged corporate loans, they have exponentially increased their exposure to the entities that hold those very loans. This is a hydraulic displacement of risk. Under the pressure of Basel III and Dodd-Frank, banks did not eliminate credit risk. They transmuted it. They shifted from holding the underlying corporate asset to holding the liability of the shadow bank that owns the asset. The banking sector has effectively become the infrastructure for the $2 trillion shadow behemoth. By providing the plumbing, the liquidity and leverage required to fuel private credit, the banks have remained inextricably linked to the solvency of the funds to which they ostensibly transferred their risk. This tiered financing structure means that when the underlying middle market borrowers fracture, the shock is transmitted hydraulically back to the balance sheets of the global systemically important banks, GSIBs. The separation between banks and shadow banks has eroded into a state of total interdependence. Through the mechanisms of subscription line facilities, NAV loans, and synthetic risk transfers, the regulated banking system has financed the very competition that displaced it. The system has not de-risked. It has merely added layers of opacity and synthetic leverage between the point of origination and the point of failure. Section 2. Subscription line coupling. The foundation of this systemic coupling is the subscription line facility, also known as a capital call facility. These are revolving credit lines provided by syndicates of banks to private credit and private equity funds. These loans are not secured by the underlying portfolio companies, but by the unfunded capital commitments of the fund's limited partners, LPs, such as pension funds and insurers. The growth of this exposure has been non-linear. Federal Reserve data indicates that credit lines to non-depository financial institutions, NBFIs, have doubled since 2012. By the first Q1 of 2025, outstanding loans to this sector reached a staggering $1.14 trillion. This is not diversified risk. It is highly concentrated among a few US G-SIBs, with JP Morgan Chase, Wells Fargo, and Citigroup allocating tens of billions of their balance sheets to these shadow partnerships. This structure creates a direct correlation between bank asset quality and institutional investor liquidity. In a benign environment, it acts as a liquidity smoother, allowing funds to invest before calling cash from LPs to boost their internal rate of return, IRR. However, in a systemic stress event, the denominator effect triggers a liquidity crunch for pension funds. If LPs default on their capital calls, the collateral backing the bank's subscription line evaporates. The bank, holding a pledge on these commitments, effectively holds a derivative claim on the liquidity of the entire global institutional investor base. By 2025, the scale of this coupling reached a point where the failure of a major pension fund could trigger an immediate impairment in the credit lines of a major G-SIB. The shadow ledger is not an island. It is a weight-bearing pillar of the regulated banking system. Section 3. First out seniority risk. The most lethal component of the bank shadow link is the first-out nature of bank credit facilities. In the hierarchical architecture of shadow banking, bank-secured credit lines represent the senior-most debt instruments of the lenders. In any scenario involving systemic distress, banks are contractually prioritized over the fund's own investors. This creates a run-risk dynamic that targets the retirement capital of the individual saver. At the first sign of credit deterioration, such as the valuation fractures seen in Tricolor or First Brands, banks have a structural incentive to pull the lines and seize cash to protect their capital. This action forces the private credit fund into a mandatory liquidation of assets into a frozen, illiquid market. Because there is no lender of last resort for shadow banks, these forced liquidations occur at fire sale valuations. The bank, being first out, is made whole, while the remaining losses are borne entirely by the retirees and pension funds, the designated bag holders of the cycle. Assignment 1. This is not a drill. Pause this video right now. Open your primary browser and search for your annuity or life insurance provider's name, followed by the phrase owned by private equity. If you see names like Athene, Corebridge, or Global Atlantic, your future solvency is already being used as fuel for the shadow ledger. When you're ready, unpause. This is the reality of the shadow bank run. The banking sector's seniority ensures that the contagion of private credit failure does not stop at the fund level. It flows through the fund and incinerates the equity of the retail investor to ensure the regulated bank remains solvent. Section 4. Synthetic Risk Transfers SRTs. As the Basel III Endgame rules began to tighten in 2024 and 2025, The system evolved a new mechanism for regulatory arbitrage, the synthetic risk transfer (SRT). These instruments saw an explosion of issuance as banks sought to reduce their risk-weighted assets (RWAs) without actually selling the loans on their books. In an SRT transaction, the bank retains a pool of loans, such as corporate debt or auto loans, but buys credit protection on the first loss or junior tranches from shadow lenders. This allows the bank to free up regulatory capital, ostensibly making the bank safer while transferring the risk of the first dollar of loss to the shadow sector. Global issuance of SRTs reached approximately $30 billion in 2024, with US dollar banks becoming the dominant drivers of the market. However, a critical vulnerability identified by the Philadelphia Fed is the use of unfunded SRTs. In these structures, the shadow lender does not post full cash collateral. Instead, the bank relies on a promise to pay when losses occur. In a systemic downturn, the shadow lender may be insolvent precisely when the bank needs the payout. This is a capital cliff risk. If the protection seller fails to pay, the risk floods back onto the bank's balance sheet instantly, triggering a massive non-linear spike in required capital. The SRT is not a shield. It is a high-voltage wire connecting the solvency of the bank to the liquidity of the shadow lender. Section 5. The circular financing loop. The synthesis of these mechanisms creates a circular financing loop that defines the terminal instability of the current regime. This is a perfect closed circle of risk rehypothecation. Deconstruct the loop. Bank A lends $100 million to Private Credit Fund B via a subscription line. Bank A wants to reduce its capital charges on its own corporate loan book, so it issues an SRT. Private Credit Fund B uses the very liquidity sourced from Bank A to purchase that SRT note. Result: the banking system has effectively financed the purchase of its own risk. This is the Ponzi engine in its final, most complex form. The risk transfer is a mathematical fiction. In a systemic crisis, this circularity amplifies the failure. If the private fund faces a liquidity squeeze, it defaults on the SRT payment to the bank. Simultaneously, the bank is hit with impairments on the subscription line it provided to that same fund. The banking sector has not de-risked. It has merely shifted from holding the corporate loan to holding a synthetic liability of a fund that owns the loan. The correlation between the two is absolute. The shadow banking system is not a parallel track. It is a derivative track, entirely dependent on the provision of bank leverage and the social safety net for its continued existence. We are witnessing a closed-loop system where risk is recycled until it can no longer be contained. The withdrawal of liquidity by anchor tenants, such as the Norinchukin Bank, is the tremor warning of the earthquake. When the loop breaks, the contagion will flow directly to the bank deposit base and the retirement annuity, realizing the very systemic risk that regulators promised to banish in 2008. We have now fully exposed the Bank-NBFI Nexus. We have seen the $1.14 trillion coupling that ensures a crisis in private credit is a crisis for the global banking system. The banking sector has merely shifted from holding the asset to holding the liability of the shadow bank. Please join the Macro Untold community by subscribing for more institutional-grade research. What we have just uncovered regarding the bank vulnerability is bad. It confirms the fragility of the entire edifice. But as we will irrefutably demonstrate for you in the next 10 minutes, for the individual retiree, the person who believes their money is safe in an annuity, it gets exponentially worse. In the next chapter, we uncover the Bermuda Magic Box. We will examine the systematic capture of insurance balance sheets by private equity firms and reveal why your guaranteed income is being used to fund a $2 trillion prayer. Subscribe for the next dossier. Chapter 12, the Bermuda Magic Box. To understand the crime, we must first inspect the weapon. In Chapter 12, we penetrate the most sophisticated regulatory arbitrage in the history of the shadow ledger, the Bermuda Magic Box. This investigation reveals how the retirement savings of the American public have been hydraulically displaced into offshore jurisdictions to manufacture profit out of thin air. By the end of this chapter, you will understand how a $100 obligation to a retiree is systematically shrunken to $80 through mathematical alchemy, leaving the most vulnerable participants in the global economy standing on the edge of a $250,000 cliff. Section 1. The Magic Box Metaphor. We begin with a visualization of the primary mechanism of displacement. Imagine a $100 liability, a contractual obligation to pay a retiree's monthly check, entering a box on the shores of Bermuda. In the United States, under the National Association of Insurance Commissioners framework, that $100 liability is treated with clinical conservatism. Regulators require it to be discounted, a mathematical process of determining today's value for a future payment, using the yields of high-grade corporate bonds. This ensures that the insurer holds $1 of high-quality assets for every dollar of future promise. However, when that same $100 liability enters the Bermuda Magic Box, the physics of finance are altered. The Bermuda Monetary Authority, BMA, employs a principles-based regime known as the Scenario-Based Approach, SBA. Under this framework, regulators permit the insurer to discount that $100 liability not at the 4% corporate bond rate, but at the yield of the actual portfolio held by the insurer. Because these portfolios are now stuffed with high-yielding private credit and shadow ledger assets yielding 7%, 8%, or even 10%, the discount rate spikes. This is the core of the arbitrage. In a traditional U.S. regulatory environment, a future $100 obligation discounted at 3% is worth roughly $74 today. But inside the Bermuda Magic Box, using a 5% or 7% discount rate, that same obligation is shrunken to $61 or less. The liability has not been paid, the risk has not been mitigated. It has simply been mathematically suppressed by assuming that the high yields of the shadow ledger are as certain as the rising sun. This is the Magic Box in action, a machine that uses the high risk of private credit to justify holding less capital against the most sacred promises in the financial system. Section 2. Shrinking the debt. The forensic consequence of this shrinking is the manufacture of paper capital. When the Bermuda Magic Box reduces a liability from $100 to $80, the $20 difference does not evaporate. It is instantly booked on the balance sheet as surplus capital or profit. To the untrained eye, the insurer appears to have become more solvent and more profitable overnight, without a single dollar of new cash entering the system. This is not profit, it is a prayer. It is a mathematical bet that the 7% to 10% yields generated by middle-market private credit will never face a fracture. Under the US NAIC rules, these aggressive illiquid assets would trigger punitive capital charges, forcing the insurer to hold a massive equity buffer to protect policyholders. But by moving the liabilities to Bermuda through modified coinsurance, ModCo treaties, the PE-backed insurer achieves reserve relief. The US entity gets to move the debt off its books, while the Bermuda affiliate holds the risk under a more flexible capital regime. The surplus capital manufactured in the box is then often divided out to the private equity parent or used to fund even more aggressive credit origination. We are witnessing the systematic cannibalization of the insurance safety net. By utilizing scenario-based approaches, these firms are effectively front-loading future potentially risky yields and booking them as realized gains today. It is a hydraulic loop. The higher the risk the insurer takes in private credit, the higher the discount rate they can apply and the more profit they can manufacture from their retiree liabilities. The debt isn't being retired. It's being hidden in a mathematical basement where the lights have been turned off. Section 3. The Athenization of Insurance. To understand why this box was built, we must identify the architects. We are witnessing the Athenization of the American insurance industry, a term derived from Apollo Global Management's strategic capture of Athene Holding. Historically, life insurers were conservative fiduciaries, matching long-term annuity liabilities with highly liquid, boring government and corporate bonds. But the decade of zero interest rate policy, ZREP, incinerated the returns on those safe assets, leaving insurers unable to fund 3% or 4% annuity guarantees. Private equity titans Apollo, Blackstone, KKR, and Brookfield offered a predatory solution. They acquired the insurers to gain control of their permanent capital, the trillions in sticky retiree liabilities that cannot be withdrawn on demand. Unlike traditional private equity funds that must return capital every 10 years, an insurance balance sheet provides a theoretical infinity of capital. By 2024, PE-owned insurers held over $704 billion in assets, representing nearly 7.8% of the entire U.S. industry. This is a total inversion of the insurance model. The insurer is no longer a protector of capital. It is a funding vehicle for the PE firm's credit machine. Through investment management agreements, IMAs, the PE parent extracts multiple layers of fees while stuffing the insurer's balance sheet with its own originated loans. This creates a lethal moral hazard. The PE firm is incentivized to maximize loan volume to generate fees, regardless of credit quality, knowing that the ultimate risk is held by the annuity policyholder. The insurer has become the buyer of last resort for the parent firm's most illiquid and complex deals. Section 4. Radical allocation shifts. The forensic evidence of this capture is written in the Schedule BA filings. PE-owned insurers have executed a radical and unprecedented shift in asset allocation, moving away from public markets and into the most opaque corners of the shadow ledger. While traditional insurers hold the majority of their portfolios in high-grade bonds, PE-owned entities have significantly higher concentrations of asset-backed securities, ABS, and collateralized loan obligations, CLOs. By late 2024, Structured securities rose to 31% of the total bond investments for these firms, totaling $133 billion. More alarmingly, a staggering 67% of their other long-term assets are investments in affiliated entities. This is the definition of a closed-loop system. The PE firm originates a loan, the PE firm packages the loan into a CLO, and the PE firm's captive insurer buys the riskiest equity or junior tranches of that CLO. These alternative allocations often include high-risk equity-like tranches that the NAIC is now attempting to reclassify to prevent rating arbitrage. These assets are frequently unrated and valued using the same Level 3 mark-to-model methodologies we exposed in Chapter 4, Episode 1. Inside the Bermuda Magic Box, these illiquid assets are given a premium valuation, while their volatility is laundered through infrequent reporting. The result is a balance sheet that appears stable while holding a concentrated bet on the very corporate sector currently being squeezed by the floating rate trap. Section 5. The $250,000 cliff, the ultimate deception of the Bermuda Magic Box, is the illusion of safety. Millions of American retirees believe that annuities are guaranteed, in the same way bank deposits are insured by the FDIC. They are not. There is no federal backstop for the insurance industry. If a PE-owned insurer faces a liquidity fracture due to a wave of private credit defaults, the Federal Reserve will not provide a discount window and the Treasury will not provide a bailout. Protection is provided solely at the state level by state guarantee associations. These associations are porous, capped, and fundamentally undercapitalized for a systemic event. In the event of an insurer failure, the cash surrender value of your annuity is typically protected only up to $250,000 per individual in most states, including Florida and Texas. If you rolled over a $1 million $480 into a PE-backed annuity, you are an unsecured creditor for the remaining $750,000. This is the $250,000 cliff. In a shadow bank run where multiple insurers face simultaneous stress due to correlated exposures in private credit, the guarantee system itself could be overwhelmed. These associations are funded by assessments on other insurers. If the largest players are all holding the same toxic magic box assets, there is no one left to pay the assessment. The retiree is the ultimate bag holder of the regulatory arbitrage, discovering only after the fracture that their guaranteed income was actually a high-leverage bet on the survival of the shadow ledger. It is not profit, it is a prayer that private credit yields will never fail. We have now fully exposed the Bermuda Magic Box and the systematic capture of retirement capital. We have seen how the system manufactures solvency while building a cliff for the individual saver. Check your annuity provider. Is it owned by a private equity firm? Does your future rely on a Bermuda discount rate? Let us know your findings in the comments below. What we have just uncovered regarding the insurance vulnerability is bad. It confirms the precariousness of the retirement system. But as we will irrefutably demonstrate for you in the next 10 minutes, the liquidity fueling this entire box is currently being withdrawn by an anchor tenant across the Pacific. In the next chapter, we examine the Japan connection. We will step inside the boardrooms of the Norinchukin Bank to reveal why the CLO Whale is liquidating $65 billion in assets, and why this withdrawal serves as the final tremor before the earthquake. Chapter 13. The Japan Connection. Norinchukin. To understand the crime, we must first inspect the weapon. In Chapter 13, we move across the Pacific to identify the anchor tenant of the global shadow banking system, the Japanese depository institutions. We are stepping inside the vaults of Tokyo to reveal how the retirement savings of Japanese farmers became the primary liquidity source for the US private credit boom. This is a forensic investigation into the Japan connection, the high-voltage wire that has fueled the $2 trillion shadow ledger for over a decade. By the end of this chapter, you will understand how a sovereign interest rate shock in Japan has triggered a $65 billion liquidation that is currently removing the floor from the global credit market. Section 1. The Whale in the Room. The structural integrity of the $2 trillion shadow ledger relies on a functioning market for securitization. Private credit funds do not simply hold loans to maturity, they package them into collateralized loan obligations, or CLOs, to free up capital and recycle their bank credit lines. For the past decade, this securitization machine had a reliable, price-insensitive anchor tenant, the Norinchukin Bank, colloquially known in the credit markets as Nochu. Norinchukin is not a traditional investment bank. It is a Japanese cooperative bank serving the agricultural, forestry, and fishery industries. It holds a massive, stable deposit base of over 100 trillion Japanese yen, approximately $700 billion. However, because Japan's agricultural sector is shrinking, the bank has limited domestic lending opportunities. To generate the yield required to pay its depositors, Norinchukin was hydraulically forced to become one of the world's largest hedge funds. Nochu's strategy was clinical and concentrated. It became the CLO Whale, buying a significant percentage of the global issuance of AAA-rated CLO tranches. These tranches represent the senior-most portion of the capital stack, protected by subordinated layers that absorb the first dollar of corporate defaults. To a conservative Japanese bank, these assets offered a free lunch, higher yields than Japanese government bonds with a perceived LAA safety rating. At its peak, Norinchukin's price-insensitive bid compressed credit spreads globally. By providing a guaranteed buyer for the senior-most debt, Nochu lowered the cost of funding for U.S. private equity firms and shadow lenders. This Japanese floor allowed the shadow ledger to expand at a non-linear velocity. This floor was predicated on a state of permanent low interest rates. The whale was effectively providing the liquidity for the entire world's leveraged debt, oblivious to the fact that its own foundation was being incinerated by a shifting macro regime. Section 2. The Sovereign Bond Trigger. The crisis that finally capsized the whale did not originate in the shadow ledger, but in the lit markets of sovereign debt. To fund its massive overseas investments, Norinchukin employed a lethal maturity mismatch. It purchased long-dated, low-yielding US Treasuries and European sovereign bonds during the ZIRP era, funding them with short-term currency swaps. When the Federal Reserve and the European Central Bank initiated the most aggressive rate hike cycle in 40 years, the physics of this trade inverted. The value of the long-term bonds collapsed as interest rates rose, while the cost of the short-term funding, the dollar funding costs, soared. This created a negative carry scenario where the bank was paying more to borrow dollars than it was earning on the assets those dollars purchased. The scale of the destruction was absolute. In the first half of fiscal year 2024 alone, Norinchukin reported losses attributable to owners of nearly 894 billion Japanese yen, approximately $6 billion. By late 2024, the bank expected a total net loss for the fiscal year of 1.5 trillion yen, or $9.7 billion. This was not a localized failure. It was a sovereign-scale trigger event. Assignment 1. This is not a drill. Pause this video right now. Open a browser and search for Norinchukin Bank FY2 024 net loss. Compare that figure to the market capitalization of a major USAD regional bank. You will find that the whale lost more in 6 months than the entire value of many institutions you consider stable. The losses were so massive they drew immediate comparisons to the collapse of Silicon Valley Bank, with one critical difference. SVB lost its deposits, while Nochu is losing its very capital base. When you're ready, unpause. Section 3. The $65 billion liquidation. To repair its capital ratio and stem the bleeding from its sovereign bond portfolio, Norinchukin was forced into a desperate non-linear retreat. The bank announced a massive portfolio restructuring, initiating a plan to liquidate 10 trillion Japanese yen, or $65 billion, of its low-yielding assets. This $65 billion liquidation is the first tremor of the shadow bank run. While the bank's stated focus was on selling sovereign bonds, the hydraulic pressure of the losses forced a broader retrenchment. Nochu's CLO holdings, which stood at 7.4 trillion Japanese yen in March 2024, began to fluctuate violently as it managed its risk-weighted assets. The withdrawal of the whale has removed the anchor bid from the global credit market. When a price-insensitive buyer of $65 billion in assets suddenly becomes a forced seller, the floor evaporates. Spreads on AAA-rated CLO tranches have begun to widen as other market participants realize the largest buyer in history is no longer there to catch the falling knife. This widening is a thermal event for the shadow ledger. The $65 billion liquidation is not merely a transfer of assets, it is the destruction of a liquidity backstop. Without Nochu, there is no one left with the scale or the lack of price sensitivity to absorb the massive volume of leveraged debt currently approaching the 2026 maturity wall. The whale hasn't just left the room, it is being sold for parts, and the ripple effects are currently jamming the conveyor belt of the entire private credit industry. Section 4. The conveyor belt jams. To understand why the Japanese retreat is terminal for the shadow ledger, we must examine the mechanics of the conveyor belt. Private credit funds rely on a continuous cycle. They originate loans, hold them on a bank-funded subscription line, and then exit by selling those loans into a CLO. This allows them to repay the bank and use the line to fund the next deal. This conveyor belt only functions if the economics of the CLO are profitable. A CLO is an arbitrage vehicle. It only works if the yield on the underlying loans is significantly higher than the cost of the liabilities, the interest paid to the AAA, AA, and BBB bondholders. When the Japan connection was active, the low cost of AAA debt, thanks to Nochu's bid, made this arbitrage highly lucrative. Today, the conveyor belt has jammed. Because the Japanese bid has evaporated, the spreads on AAA tranches have widened. This has increased the liability cost of the CLO. Simultaneously, the yield on the underlying loans is being squeezed by the floating rate trap and rising corporate distress. The arbitrage has closed. If the CLO issuance machine stalls, the private credit funds are stuck with their loans. They cannot recycle their capital. They cannot return cash to their institutional investors. This conveyor belt jam is the mechanism of the freeze. The $2 trillion shadow ledger, designed for high-velocity movement, is becoming a stagnant pool of illiquid debt. The withdrawal of Japanese capital hasn't just made credit more expensive, it has broken the machine that allows credit to exist outside the banking system. Section 5. Democratization via CLO ETFs. As the smart money in Japan initiated its retreat, the asset management industry engineered a final desperate pivot to maintain the illusion of liquidity, the retailization of CLOs. To fill the multi-billion-dollar void left by Norinchukin, the industry has turned to the ultimate bag holder, the retail investor. The 2024-2025 period has seen an explosion in CLO ETFs, exchange-traded funds. These products take the complex illiquid debt structures previously held by Japanese banks and wrap them in a package that promises intraday liquidity to individual brokerage accounts. ETF assets under management in this sector surged from a mere $2 billion to over $14 billion in less than 2 years. The withdrawal of Japanese institutional capital was explicitly cited by industry analysts as a primary driver for this shift. The risk that was previously held on the balance sheet of a capitalized cooperative bank is now being distributed to millions of 401 PCS and retail portfolios. The systemic implication is lethal. ETFs promise that you can sell your position at 2 p.m. on a Tuesday, but the underlying assets, the private corporate loans, trade by appointment and can take weeks to liquidate. This structural fragility ensures that the next credit crunch will not be a bank failure, but a broken ETF scenario where the creation and redemption mechanism fails. The democratization of risk has ensured that when the shadow bank run accelerates, the retail investor will be the one standing at the end of the conveyor belt, holding the most complex and illiquid instruments in the global architecture. The withdrawal of the Japanese whale is not a market correction, it is a seismic event. We have now traced the Japan connection and seen the $65 billion liquidation that has removed the floor from the shadow ledger. We have documented how the industry is desperately attempting to dump this risk into the retail market through CLO ETFs. If you learned something new about how global capital flows are being repurposed to trap your savings, hit the like button. What we have uncovered regarding the Japanese retreat is bad. It confirms the system has lost its anchor. But as we will irrefutably demonstrate for you in the final chapters of this investigation, for the individual saver who believes they are diversified, it gets exponentially worse. Mastering the Japan connection leads us to the heart of the trap. In the next chapter, The Retail Trap and Behavioral Panic, we reveal exactly how you have been designated as the exit liquidity for the institutional class. We will expose the behavioral mechanisms designed to lock you in the room while the smart money flees for the exit. Chapter 14. The Retail Trap and Behavioral Panic. To understand the final displacement of risk, we must look at who is left holding the liabilities. Chapter 14 deconstructs the mechanism by which the most sophisticated participants in the global economy are using retail capital as their ultimate escape hatch. Section 1. You are the exit liquidity. The transition from the golden age to the global unwind is characterized by a fundamental restructuring of capital flows that parallels the subprime explosion of 2008. For a decade, private market growth was fueled by institutional capital, pension funds, sovereign wealth funds, and endowments chasing the illiquidity premium in a low-yield world. Forensic analysis of the 2024-2025 period proves these institutions are now net sellers, besieged by the denominator effect and a desperate need for cash. As these giants retrench, the titans of asset management, Blackstone, Apollo, and KKR, have executed a pivot toward the mass affluent. This is the retail trap. The strategic transformation of retail portfolios into the exit liquidity for institutional retrenchment. The asymmetry of these flows is the smoking gun of a systemic wealth transfer. Institutional investors possessing granular data and deep analytical resources are reducing their exposure to the shadow ledger through the secondary market. Transaction volume in the secondary market hit a record $160 billion in 2024, with institutional players selling their stakes at discounts of 10%. These sophisticated sellers are explicitly stating that they value immediate liquidity over the reported net asset value of the fund. They are paying a liquidity premium to get out of the building. Simultaneously, the retail cohort, the doctor and dentist demographic, is being marketed in via the primary market. While institutions sell at 90 cents on the dollar to escape, retail investors are buying into the same asset classes at 100% of the marked NAV. Retail capital raised in vehicles like BC Cred or SREIT is effectively replacing the institutional capital that is fleeing the system. The risk is being recycled from those who understand it best to those who understand it least. You are not being democratized. You are being designated as the bag holder. Assignment: this is not a drill. Pause this video right now. Open the annual report for any alternative credit or private debt fund you hold. Navigate to the section regarding secondary market transactions or fair value measurement. If you see that institutional stakes in the same manager's larger funds are trading at a discount in the secondary market while your shares are being sold to you at par, you have identified the retail trap. When you're ready, unpause. The clinical reality is that retail capital is providing the fuel to sustain the asset manager's fee revenue, while institutional giants exit their positions early. This is a hydraulic movement of risk from the informed balance sheet to the uninformed 401W. The smart money has recognized that the illiquidity premium has evaporated in a high-rate environment, leaving the retail investor to subsidize the transition. Section 2. The 401k infiltration. The transmission mechanism for this risk is the democratization narrative. Facing a saturated institutional market, managers have rebranded the search for new fee-paying assets as a moral imperative to level the playing field. Apollo Global Management and Blackstone have ramped up their focus on the wealth channel, positioning private assets as the only solution to a dead 60/40ths portfolio. They have partnered with major wirehouses and retirement platforms to embed complex private credit into the very plumbing of the American retirement system. This infiltration is achieved through the accredited investor drift. Regulators have expanded the definition of accredited status, and the wealth thresholds for entry have not been adjusted for inflation in decades. This has effectively lowered the protective moat, sweeping millions of additional households into the net of the shadow ledger. Private market firms are now eyes on an $80 trillion pool of global wealth historically held in retirement accounts. The strategy involves the digitalization and gamification of access. Managers are tokenizing funds and partnering with fintech platforms to make buying a share of a private credit fund as easy as buying a stock on a mobile app. This removes the visceral sense of a lockup, creating a psychological disconnect where a fund feels liquid even though the legal structure is fundamentally illiquid. Furthermore, asset managers are now embedding private credit into ETFs and target date 401k options. This embeds complex, illiquid debt into the permanent capital base of Main Street. By partnering with State Street to launch private credit ETFs, Apollo is placing assets that trade by appointment into vehicles that promise intraday liquidity. This creates a structural fragility where the creation/redemption mechanism of the ETF can break during a period of market stress. The retirement plumbing is being stuffed with unrated, opaque debt that is senior most to your future solvency. This is not just a search for yield, it is the Athenization of the retirement system. Your 411 is no longer a collection of transparent public securities. It is becoming a funding vehicle for the asset manager's credit machine. They extract origination fees, management fees, and performance fees, while you inherit the tail risk of the 2026 maturity wall. The infiltration is complete. The exit door is already being narrowed. Section 3. Behavioral panic at the gates. The core structural flaw of this retailization is the liquidity mismatch. Retail investors are sold semi-liquid structures, such as interval funds or non-traded BDCs, which promise quarterly liquidity. This liquidity is a mirage. The underlying assets, the 7-year loans to middle market zombies, take months or years to liquidate. To bridge this gap, managers utilize redemption gates. These gates are typically capped at 5% of the fund's NAV per quarter. While marketed as a tool to prevent fire sales, these gates create a terminal prisoner's dilemma for the individual investor. Because liquidity is limited, there is a massive first mover advantage to redeem early. If you wait to see the results of a market correction, you will find yourself at the back of a queue that only moves 5% every 3 months. The behavioral panic is hydraulic. When redemption requests exceed the 5% cap, the fund gates or suspends withdrawals. This signals distress to the entire market, triggering a run on the gate where every investor rushes to file their paperwork before the door closes for the next quarter. We saw this in late 2022 with Blackstone's SREIT, which capped redemptions for 15 consecutive months, as withdrawal requests peaked at $5.3 billion. Gating does not just trap your capital, it initiates a cycle of adverse selection. To meet the trickle of allowed redemptions, the fund manager is forced to sell their most liquid, highest quality assets. This leaves the remaining bag holders with a portfolio concentrated in the lowest quality, most illiquid zombie companies. Your capital is used to pay the early exit smart money, leaving you holding the incinerated remains of the fund's equity. Behavioral panic ensures that by the time you realize the trap has shut, the foundation has already been sold off to the highest bidder. Section 4. SREIT and the Liquidity Mirage. If BRIT was a warning, the Starwood Real Estate Income Trust, SREIT, is the realization of the worst-case scenario. In May 2024, facing persistent liquidity pressure, Starwood executed a non-negotiable tightening of the trap. They slashed monthly repurchase limits from 2% to a clinical 0.33% of NAV. This effectively fundamentally altered the contract with the investor, extending the theoretical exit timeline from months to years. At a 0.33% monthly redemption rate, the liquidity is no longer semi-liquid. It is a terminal freeze. As of mid-2025, SRE still faced a backlog of $850 million in unsatisfied withdrawal requests. The fund was forced to sell $1.6 billion in properties between December 2023 and May 2024 simply to keep the gates cracked open. This is the death spiral of the liquidity mirage. Selling the crown jewels to fund the exit of a fraction of the investor base, while the underlying net asset value remains artificially propped up by internal models. This case study proves that the guaranteed liquidity of an interval fund is a discretionary privilege, not a right. The manager can lower the gates at any moment to protect their own fee stream. In a systemic shadow bank run, the SRE8 model becomes the industry standard. When the 22/6 maturity wall hits and defaults in the soldier cohort spike, every semi-liquid vehicle will be forced to choose between total liquidation and the 0.33% lock-in. The retail investor is trapped in a hydraulic vacuum. You cannot sell your shares on an exchange, and you cannot force the manager to buy them back. You are an unsecured creditor to your own retirement account, waiting for a payout from assets that no one wants to buy. SREIT is the proof that in the dark markets, the exit is not a door, it is a needle's eye. Section 5. The Run Dynamics. The final phase of the investigation is the anatomy of the run. A shadow bank run is not a run on deposits, but a run on valuation confidence. It is triggered when the disconnect between the reported net asset value and the economic reality of the market becomes too wide to ignore. When public markets fall 20%, but a private fund reports a positive return of 6%, a rational investor recognizes the valuation lag. This creates an arbitrage that incentives a systemic run. If a fund's NAV is marked at 98, but the secondary market for similar assets is bidding 85, there is a profound incentive to redeem immediately at the marked price. The first investors to get their money out receive 98 cents on the dollar, effectively extracting the 13-cent difference from the investors who remain. This first mover advantage accelerates the panic, as everyone realizes the fund's equity is being cannibalized by the exit queue. The sequence of collapse is clinical. Retail panic, fear or liquidity needs elsewhere trigger a wave of redemption requests. Gates triggered. Requests exceed the 5% quarterly cap, and the fund gates. Contagion, the gating of one marquee fund, like a BC Cred, signals a systemic crisis, triggering preemptive runs on all other semi-liquid funds. Forced selling. Funds sell their most liquid loans to larger companies, driving down prices in the public secondary market. Valuation collapse. Market prices drop to 80 or 85 cents, forcing a massive non-linear write-down of the remaining illiquid assets. Section 5. The run dynamics. The final phase of the investigation is the anatomy of the run. A shadow bank run is not a run on deposits, but a run on valuation confidence. It is triggered when the disconnect between the reported net asset value and the economic reality of the market becomes too wide to ignore. When public markets fall 20%, but a private fund reports a positive return of 6%, a rational investor recognizes the valuation lag. This creates an arbitrage that incentives a systemic run. If a fund's NAV is marked at 98, but the secondary market for similar assets is bidding 85, there is a profound incentive to redeem immediately at the marked price. The first investors to get their money out receive 98 cents on the dollar, effectively extracting the 13-cent difference from the investors who remain. This first mover advantage accelerates the panic, as everyone realizes the fund's equity is being cannibalized by the exit queue. The sequence of collapse is clinical. Retail panic, fear, or liquidity needs elsewhere trigger a wave of redemption requests. Gates triggered. Requests exceed the 5% quarterly cap, and the fund gates. Contagion, the gating of one marquee fund, like a BC Cred, signals a systemic crisis, triggering preemptive runs on all other semi-liquid funds. Forced selling. Funds sell their most liquid loans to larger companies, driving down prices in the public secondary market. Valuation collapse. Market prices drop to 80 or 85 cents, forcing a massive non-linear write-down of the remaining illiquid assets. This is the cliff edge repricing risk we warned about in Chapter 5. In the shadow ledger, prices stay at par until they don't. The lack of price discovery ensures that when the adjustment happens, it is not a correction, but an incineration of principal. The system has no lender of last resort to arrest this spiral. The Federal Reserve is legally prohibited from bailing out individual private funds, and the political optics of rescuing private equity billionaires would be toxic. You are on your own at the edge of the cliff. The trap is set, and the 2026 maturity wall is the trigger. We have documented how you have been designated as the exit liquidity for the institutional giants. We have seen the behavioral trap of redemption gates and the liquidity mirage of SREIT. Subscribe to Macro Untold to protect your capital and receive the next dossier. What we have uncovered throughout this investigation is a $2 trillion structure of risk designed to displace losses onto the retail saver. But mastery of the problem leads to the necessity of a solution. In our final chapter, the Sovereign Exit Protocol, we provide the actionable solution to this 3-hour investigation. We will show you exactly how to audit your 401k, identify the zombies in your portfolio, and migrate your wealth into bearer assets before the system closes for good. You are now out of the building. Subscribe for the final protocol. Chapter 15. The Sovereign Exit Protocol. This is a forensic investigation into the final preservation of your capital. By the end of this chapter, you will possess the Sovereign Exit Protocol, a clinical, multi-step defensive strategy designed to decouple your wealth from the shadow ledger. We have concluded the autopsy of a $2 trillion system built on volatility laundering and Ponzi dynamics. We have seen how the Sharpe ratio lie was used to frame a mirage of safety, while the AI bridge and the Bermuda Magic Box displaced terminal risk into the darkness. Now, the investigation moves from the crime scene to the bunker. To understand the crime, we must first inspect the weapon. To survive the crime, we must now execute the solution. This hour provides explicit instructions for auditing your retirement accounts, identifying the zombies in your portfolio, and migrating your wealth into bearer assets before the 2026 maturity wall triggers a systemic closure. Section 1. Auditing the 401k. The first stage of the protocol is the clinical deconstruction of your primary retirement vehicle. For a decade, the democratization narrative has been used by wirehouses and asset managers to embed complex private credit into the very plumbing of the American 4010 core system. This infiltration was not accidental. It was a strategic move to secure permanent capital from the mass affluent to provide exit liquidity for institutional smart money. You must now perform a forensic audit of your retirement account to identify hidden allocations to the shadow ledger. Begin by scrutinizing any line item labeled as an income fund, opportunistic credit, or alternative credit allocation. These titles are often euphemisms for vehicles that hold unrated, illiquid middle-market debt characterized by high payment in kind, PIK concentrations. Search the fund's underlying prospectus for the phrase recurring revenue loan or RARL multiple. If these terms are present, your capital is being used to finance tech sector hallucinations that have no operational profit backing. Next, you must identify the presence of interval funds within your target date options or balanced portfolios. These funds are the principal mechanism for the retail trap, offering the illusion of quarterly liquidity while investing in 7-year illiquid loans. Under the hood, these vehicles utilize a 5% quarterly gate to trap capital when redemption requests spike. Forensic analysis of the 2024-2025 period proves that while you are a net buyer at 100% of the marked net asset value, NAV, institutions are net sellers in the secondary market at 15% discounts. Interactive assignment. This is not a drill. Pause this video right now. Log into your 401k or brokerage portal. Navigate to the fund fact sheet for your largest fixed income or income producing holding. Search the document for the term Level 3 Assets or Mark to Model. If Level 3 assets exceed 20% of the fund's total value, you are holding a position where the manager determines their own performance fees based on subjective opinions of value rather than market reality. When you're ready, unpause. The audit must also extend to the Bank-NBFI Nexus within your portfolio. Many 401k plans include exposure to the major G-SIBs, JP Morgan, Wells Fargo, and Citigroup that have extended over $1.14 trillion in credit lines to shadow banks. These banks represent the first out seniority risk. In a systemic stress event, these banks will pull their lines first, forcing the funds in your retirement plan to liquidate assets and crystallizing terminal losses for you, the retiree. You are currently financing the prime broker to the shadow economy. The audit is the only way to see the wire before it snaps. Section 2. The shift from counterparty assets. The second stage of the protocol requires a fundamental shift in your understanding of asset safety. You must recognize the inherent danger of counterparty assets. A counterparty asset is any financial instrument that relies on the solvency and integrity of a middleman, a bank, an insurer, or a fund manager, to deliver its promised value. In a shadow bank run, these middlemen become the primary points of failure. The most egregious example of counterparty risk is the modern annuity, particularly those held within the Bermuda Magic Box. Private equity firms have acquired life insurers to gain control of the permanent capital provided by your retirement checks. These firms move your liabilities to Bermuda, where regulators allow a $100 obligation to be discounted at 7% instead of the 4% required in the US. This shrinks the reported debt to $80 instantly, allowing the manager to book $20 as profit. This is not profit. It is a prayer that the private credit yields on the other side of the box will never fracture. Furthermore, this is a lethal misconception. Protection is provided by state guarantee associations, which typically cap protection at $250,000. If your annuity balance exceeds this cliff, you are an unsecured creditor to a firm that has concentrated its assets in CLO equity and asset-backed securities, ABS as SPACs. In a systemic liquidation, these associations, funded by assessments on other potentially insolvent insurers, will be incinerated. The shift from counterparty assets also applies to closed-end funds, NEFs, and non-traded BDCs. These vehicles rely on the extend and pretend feedback loop to maintain their distributions. They utilize NAV financing, leverage on leverage, to pay synthetic dividends when they cannot exit companies in a frozen market. This links the fate of healthy companies in the fund to the zombies currently being squeezed by the floating rate trap. To execute the protocol, you must identify every asset in your portfolio that requires a third party to remain solvent during a liquidity vacuum. If the asset cannot be held directly or lacks a government backstop, it constitutes a structural vulnerability. The displacement of risk from regulated banks into shadow ledgers means that the traditional safeguards of the financial architecture have been bypassed. You are standing at the end of a very long chain of counterparties. The shift to sovereign assets is the only way to shorten that chain before it breaks. Section 3. Migration to bearer assets. The third stage of the protocol is the physical migration of capital into bearer assets. A bearer asset is a sovereign instrument that carries no counterparty risk and can be held directly by the owner. As the 26 maturity wall approaches, the ability to bypass the shadow ledger will become the ultimate differentiator between solvency and incineration. The protocol mandates a transition toward US MLB, Treasuries, physical gold, and Bitcoin. US Treasuries held directly through Treasury Direct or a primary dealer represent the only remaining public backstop in a system that has largely migrated into the shadows. Unlike the $2 trillion shadow behemoth, the Treasury market is the foundation of global liquidity. While shadow banks lack access to the Fed's discount window, the Treasury remains the lender of last resort for the entire architecture. By holding the debt of the sovereign directly, you remove the Bermuda Magic Box from your valuation chain. Physical gold serves as the ultimate exit protocol asset. It carries zero counterparty risk and cannot be gated by a fund manager or suppressed by an autocorrelation coefficient. In a scenario where the cliff waterline fractures and private credit assets face a cliff edge repricing, gold functions as a non-linear hedge against systemic failure. It is the only asset that has never been a liability of a shadow bank. Bitcoin, categorized as a digital bearer asset, provides a mechanism for bypassing the Bank-NBFI Nexus entirely. As regulators move toward the Basel III endgame, which will sever traditional bank fund lending ties, the friction within the legacy architecture will increase. Bitcoin's decentralized ledger operates outside the shadow ledger, providing a sovereign alternative to the round-tripping and circular financing flows currently inflating AI valuations. Migration is not an overnight event. It is a clinical process of deleveraging your personal balance sheet. You must treat every dollar currently trapped in a semi-liquid interval fund as a dollar at risk of being gated. The sovereign exit protocol dictates that liquidity must be prioritized over yield when that yield is being manufactured through pie-kick interest and NAV financing. By moving toward bearer assets, you are no longer a participant in the Ponzi engine. You are an observer of its collapse. Section 4. Identifying zombies in your portfolio. The fourth stage of the protocol is the quantitative screening of your remaining corporate exposures to identify the zombies currently rotting in your portfolio. A significant minority of middle-market borrowers, estimated between 20% and 25%, are currently operating with an interest coverage ratio (ICR) below 1.0x. This means they cannot cover their debt service from operating profits and are technically insolvent. You must audit any business development companies, BDCs, you hold for high bad PIK concentrations. While the industry markets PIK as a strategic flexibility, forensic data proves that 53% of PIK instances in 2024 were distress-driven. A BDC with more than 10% of its total income derived from PIK is a red flag entity. This illusory income is used to pay you a cash dividend that the underlying company never actually produced. You are receiving your own future principal back as a yield, while the borrower's debt load doubles every 6.5 years through negative amortization. Screen for companies with a bimodal ICR distribution. While high-margin generals may appear healthy, the soldier cohort of cyclical, labor-intensive firms has already fallen into the cash burn trap. Lenders are currently using amend and pretend tactics to carry these assets at par between 97 and 100 cents to protect their IRR marketing metrics. This prevents the downward slope of price discovery, ensuring that when the default happens, it will be a catastrophic, non-linear liquidation. Look for the Covenant Holidays indicator. If the funds in your portfolio have doubled their covenant waivers quarter over quarter, the manager has lost their legal right to intervene as the credit rots. These managers are no longer credit analysts. They are option value gamblers, betting that interest rates will collapse before the 2026 maturity wall hits. If the ICR is below 1.0x and the PIK is toggled on, you are holding a dead company walking. Assignment: this is not a drill. Pause this video right now. Find the most recent quarterly report for any BDC or private credit fund you own. Navigate to the Financial Highlights section and calculate the ratio of PKIC income to total investment income. If this number exceeds 10% or if the shadow default rate, which includes distressed amendments, is not disclosed, you are holding a zombie-infected vehicle. When you're ready, unpause. Section 5. The investigator's final verdict. The investigation is complete. The forensic evidence gathered across 3 episodes leads to a singular, unavoidable conclusion. The private credit market has not eliminated risk. It has hydraulically concentrated and displaced it through valuation smoothing and layered leverage. We have documented the metamorphosis of global finance from a transparent, regulated banking system to a synthetic parallel architecture characterized by volatility laundering and Ponzi dynamics. The Sharpe ratio Lee served as the framing device to lure $2 trillion of capital into a state of suspended animation. The system has used mark-to-model accounting to defer reality indefinitely, creating a $620 billion deficit of truth that will be reconciled at the 2026 maturity wall. We have seen the Bermuda Magic Box turn retiree checks into prayers, and the AI bridge turn fabricated revenue into debt-backed hallucinations. The golden age of private credit was an artifact of artificial liquidity and zero interest rate policy. In the new regime of the bear steepener, the floating rate trap has rendered 1/3 of borrowers technically insolvent. The withdrawal of the Japanese whale, liquidating $65 billion in assets, is the final tremor before the earthquake. The system is no longer functioning as a mechanism for capital allocation. It is a self-referential engine of survival designed to extract fees. My final verdict is clinical. The individual investor has been designated as the ultimate exit liquidity for this cycle. You were told you were being democratized, but you were being trapped. You were promised senior secured status, but you were being subordinated to bank credit lines and NAV loans. The sovereign exit protocol is not a suggestion. It is the only remaining mechanism for mitigating the coming fracture. You now possess the critical knowledge. You are now out of the building. We have concluded the forensic autopsy of the $2 trillion shadow bank run. We have traced the migration of risk from regulated banks into a synthetic parallel system characterized by volatility laundering and Ponzi dynamics. We have exposed the Sharpe ratio lie, the AI-ARR bridge, and the Bermuda Magic Box. Most importantly, we have provided the sovereign exit protocol to ensure you are not the bag holder for the 2026 maturity wall. The facts were deliberately misrepresented, but the data is now in your hands. Your future solvency is no longer jeopardized by ignorance, but determined by your execution of the protocol. The crisis is no longer yours. It is your observation. You now possess the forensic skills to see the shadow ledger for what it is. A $2 trillion trap that is currently closing. Don't forget to subscribe for the next dossier. Thanks for watching Macro Untold.